Good morning, everybody.
Good morning.
My name is Patrick Gardner, and on behalf of the Events and Education Committee of SFAR, and in conjunction with Everbank, we have our Exit Strategy Seminar today. So welcome. As I said, I'm with Everbank. I'm a sales manager, and my team of loan officers and support staff are here to serve the real estate community's needs and get you guys closed quickly. Our company is actually being acquired in the middle of a merger right now by TIAA. You may also know by the name TIAA CREF. It's a very large company, almost $1 trillion in managed assets. Reason I bring it up, we're not just your grandma's annuity company, no. We are the largest global investor in agriculture, the second largest grower of wine grapes in the United States by acreage, and the third largest commercial real estate manager in the world. And we also, as I said, have $900 billion in managed assets. So we know a little bit about wealth, wealth building, and the real estate is the probably number one asset class for people who want to grow their wealth. And our speakers today are going to talk about keeping that wealth in the family and not writing a check to the government for maybe 30 or 40% of that. We are living into interesting times right now. We have a seller's market, obviously, in San Francisco, and it's a seller's dream until it becomes a nightmare or a source of insomnia when you're thinking about writing a check for 30 or 40% in capital gains tax. Our discussion today will hopefully provide some relief for that stress and could not be better timed. For the last 2 weeks, the White House has unveiled a new tax plan, which could have serious impacts on the real estate sales and capital gains tax rates moving forward. In addition, today the House is voting on a new health care bill, so that could have even more surprises in store. But thankfully, we have two great problem solvers with Ralph Bungie to my left and John Vickers to my right. I'm going to do a brief introduction of them both, and we're going to give them about 20 minutes each to introduce their concepts and ideas, and then we'll move kind of to more of an open discussion and question period. All right, does that sound good? Yeah. Excellent. All right, Ralph Bungie to my left has over 35 years of practical and professional experience in financial management, accounting, income tax, real estate, and exchanges. He is co-founder and president of Independent Exchange Services, Inc., and co-founder and president of Reverse Exchange Services, Inc., both here in San Francisco. In his professional service to the exchange industry, he has held the position of president, director, and officer of the Federation of Exchange Accommodators. He has sat as chairman of the Federation's Ethics Committee and been called to testify as an expert witness by the FBI in cases of exchange fraud and regulation. He has many more accolades, which you can read about in his 10-page handout that we'll go over soon. John Vickers to my right is a senior advisor for Sperry Van Ness and a board member for Escrow Collateral. His experience comes from over 35 years and hundreds of transactions. He specializes in the East Bay multifamily and retail properties market. His property sales experience also includes portfolio, industrial, office, self-storage, and special use and hospitality properties. Many of these transactions were complex, involving sale leasebacks, 1031 exchanges, and also monetized installment sales. John is active in civic and trade organizations. He is past president and current vice president of the Berkeley Property Owners Association, broker member in Berkeley, National Association of Realtors member, and member of CCIM, and a Berkeley Rotarian. So I'm going to hand it off to Ralph first to talk about exchanges. Again, Patrick Gardner with Everbank. Good luck.
By the way, Patrick, is it true that if any of these folks open an account with the new Everbank, that you'll send them a case of wine?
Charles Shaw.
See, now you've heard it. Now you've got an option. It could have been a toaster, but it's much better to get the wine. In any event, my name is Ralph Bungie. I've been doing 1031 exchanges actually for 37 years. And a little time before that, I had actually set up a delayed exchange before the Starker case, which you may all recall, settled in December of 1979. I actually did a delayed exchange to solve a problem for a client before that case became case law. And we started our firm in January 6th of 1980 to do 1031 exchanges as a qualified intermediary. So I'm in my business, my colleagues in the industry refer to me as a dinosaur. And I actually go back to the Paleolithic period pre-Starker. So that's actually where I'm coming from in my background. And we really enjoy doing what we're doing. My son and I run the business, and we're always here. And we've been working with San Francisco brokers and stuff on their transactions all that period of time. And people know that when they call us, they get answers to their questions. And that's what we're always encouraging you to do. Whenever you have a question, from whatever you haven't picked up in this little cheat sheet, which you keep at your desk because it'll give you some ideas from time to time, we'll be there to answer them for you. So always feel free to call. It's not a problem. Now, let's start with the basics. I know that this is a little early in the morning to talk about taxes, but if you haven't had your breakfast yet, that could be a problem. But believe me, in this case, we're talking about deferring taxes, because we're not talking about tax-free exchanges. We're talking about tax-deferred exchanges. There is a way to make them tax-free, but you have to exercise the death option in order to accomplish that objective. Okay, so, and we don't want to do that. We don't recommend that for clients. We just say, it's deferral. That's the name of the game. Now, if you, in order to get the basics behind, understand this. There are 4 general rules that you always want to keep in mind. That once you understand these general rules, a lot of the things that we'll talk about will spin off from that. And the first rule of thumb is the Likekind Requirement. Likekind means any kind of real estate. Makes no difference what it looks like. A single family residence could be a investment property. It could be a trade or business property. It could be a second home. It could be a personal residence. It could be a personal use property. But only 2 of those qualify for 1031 treatment. Trade or business or investment. And it can go trade or business for trade or business, or trade or business for investment, or investment for trade or business. So, for example, if you were going to retire and you had a property that you were occupying as your business, you could trade out of it into an apartment house and live off the income, assuming there's any income to be gotten in today's market. So it's a classic thing, like kind for like kind. Now, keep in mind that a tenant in common interest is a fractional ownership interest in real estate. That can be traded. However, if it's a partnership or an LLC that has multiple partners, then that partnership can do the exchange because it's the taxpayer and it must stay together. But if it wants to go separately, then we have problems. There are techniques for dealing with those problems, but we won't get into all those today. But believe me, the best thing to do is own it as a tenant in common, not as a share in a partnership or a share in a trust. So stick with a like-kind, piece, and you'll be fine. Now, the second requirement, whenever you sell a property, you have a gross sales price, which you're all familiar with. That's your listing price, and hopefully the acceptance price. You subtract your commissions and closing costs. That gets you to net sales price. That's the target purchase price for buying something. Subtract from that any mortgage or debt. That gives you your equity. Your equity is what we call in the trade your exchange credit. And the requirement to be successful is to buy a property or combination of properties, because you can add them together, that are equal to this net sales price number and purchase price plus closing costs, and is equal or up in the sense that all of the equity goes in as down payment. Now, you can add additional equity to take on less debt. That's no problem. Then you don't have to take on as much debt. And people say, well, what about the debt? They worry about the relief of the mortgage. You don't have to worry about that. As long as you're equal or up the equity and the net sales price, you're automatically equal or up the mortgage. So you can do that with a new mortgage, or you can do it with additional cash to offset the mortgage that you were relieved of. Now, that's the financial structure rule. So first one, like kind. Second, financial structure. Third one, this is the one that drives everybody bananas. This is particularly true for your clients who are over 40. And the reason for that is that people over 40 have learned that time passes faster for people over 40, right? Any of you over 40? Maybe you're all. Well, I know there's one guy here who's definitely over 40. I'm over 40. So I can tell you it passes quick. And you have a little timing problem on your exchange. Because from the day that you close escrow on what you sell, you have only 45 days left to identify in writing the properties you wish to buy. You don't have to be in contract, but it helps. The last thing you want to do is identify something and have 16 offers, up there competing after the 45th day. So getting identification early on is really important. Now, that 45 days just identifies, and you can typically, what people identify is anywhere up to 3 properties without regard to value. And those 3 properties, you can buy 1, 2, or all 3. Now, you have another little problem. You have to close escrow on whatever you're going to buy no later than 180 days after the close of escrow. So if you closed escrow on what you sold today, tomorrow would be day number 1. That's how it counts. So day 0 is the day you closed. Now, the 180th day is usually not a problem, but the 45 days can be a challenge. Okay. Now, if let's say that you were selling a large property and you wanted to buy a whole bunch of smaller properties, there's a thing called the 200% rule. And all that means is you could list more than 3 properties as long as the gross purchase prices of each of those properties added together do not exceed 2 times the gross sales price of what you sold. So the 200% rule, 200% times your gross sales price, add it up, stay under the 200%, you can list more than 3. Okay? And when we do our transactions, people identify directly with us as a qualified intermediary, and that's how we do it. We sign you sign a form, or the client signs a form, we sign it back, client's got it for audit purposes. Now, the 4th thing is documents and procedures. And that's what we do as a qualified intermediary, is we provide all the documentation, the procedures, and we do a lot of hand-holding and consulting as we go through it. And we're here to help your client, solve a problem. And many times we'll come up with strategies that you hadn't even thought about that might lead to a transaction once we understand the facts. So the more information you can give us on the transaction, or your client can give us, the more helpful we can be. And for us, the reason I'm still doing this stuff at my advanced age is because I really enjoy helping people's lives work better for them. That's what I do for a living. It's fun. Plus I get to work with my son, which is another benefit. And so after 37 years, I'm still doing it. I intend to do it as long as it will let me. But it's a fun business. Now, we're going to take a look and say, what are some of the things that you might want to consider doing for a 1031 exchange? Let's say that you are working with a client. They come to you with a property to be held, they're holding for investment. Be clear that it's being held for investment or trade or business use. Find out from them what they plan on buying. Because what I want you to do is be able to get 2 commissions for the same client. Sell side, buy side. Because remember, they have to buy something, so you don't want to miss the opportunity of getting both commissions. All right? So what you do is you say, okay, well, what do you want to buy and where do you want to do it in? And if it's in your area, that's perfect. Then tell them, okay, let's pocket list the property. Just pocket list it for a time. Let's get all the curb appeal issues addressed. Let's maybe have some, the inspections done so that we can move the property very quickly when the time comes. Meantime, let's focus our attention on what we want to buy. And if you see your way clear that it's going to be no problem, pop it up in the market, put it on a multiple listing service, get it out, standard exchange, no problem. But you bought yourself a little bit more time, and you participated in an opportunity to get 2 transactions instead of just 1, and sometimes 3, depending on how many the client wants. Now, in the case that you found the perfect property, but you haven't been able to sell the one you're selling in time, we can do a reverse exchange. Now, that's an interesting transaction, because in a reverse exchange, what we do is we have a separate subsidiary called Reverse Exchange Services, Inc. And that Reverse Exchange Services, Inc. sets up an entity, an LLC, or a corporation. There are reasons why we use one or the other, to park the property you wish to buy. And so what we'll do is we'll buy the property. Now, when we buy the property, we work with the lender to get the loans all structured and put into place. And the first loan will be the one that your client is going to assume going forward. okay, after they take it from us within 180 days. But we have just now allowed you an additional 180 days from the day that we buy that property to sell the property your client has. That means you can get a better sales price. You don't have to take the first offer that comes along. And it makes a lot of difference for the client's selling strategy. And sometimes it also adds value to the buying process because you can move now. You don't have a contingency, that other people might have if they have to sell their property first before they can buy. You might be more competitive on your buy side. Even more interesting is that when clients are facing that 45-day deal and they're in their 43rd day, even 44th day, and they haven't found what they're looking for, and they just want to save taxes, and they buy a dumb property that they wish they hadn't seen for the next 7 years, right? You solve that problem. You're going through your exercise, you've got your contract, you've got a deposit up on what you're going to buy, and the buyer falls out of bed on the one you're selling. Perfect time to use a reverse exchange. So the reverse exchange, while it's a more expensive transaction overall, because you're going through escrow a second time, you've got transfer taxes, you've got a lot of other issues. In about 60 to 70% of the cases, people actually make money on a reverse exchange because of the economic benefits of buying the right property, not blowing their exchange and paying their tax, getting a better price on the property that they sell. So we have a whole process for going through and getting that all done. We need to take the time to work with the lenders, but we have lenders that we can refer to. I'm not sure, Patrick, are you guys ready to do reverse exchanges yet? Yeah. Okay. So you can't get the wine, Anyway, it's an opportunity. Hopefully the TIA will say, well, hey, that's a great idea. But in any event, we can work with lenders that you're not working with, or your client's not working with, to get something put together. So the reverse exchange is a very, very valuable exercise. Now, here's one that a lot of you here in the city will find extremely valuable. Client sells an investment property, okay? And the client still has a 35-year-old son living at home. You run into that very often? But you'd like to get the son or son and his wife into their own home. But, gee, I've got this investment property and I'm selling it. We have a little transaction called a 280A transaction. In a 280A transaction, Congress arranged things in such a way that you could put together a special tenant in common relationship between the parent and the kids to allow you to exchange into a property a percentage ownership in the property, have the kids have the other part of the property. They could finance theirs all the way, and you could just be an equity player with a down payment. And then the children pay you fair market rent for the use of your property, keeping you as an investor. And with a shared equity financing agreement, you're able to have a relationship that's different than a standard tenant in common relationship. The standard tenant in common relationship is everything is pro rata. Debt, equity, income, expense. But in a shared equity financing agreement, and we can send your client to an attorney that prepares these and specializes in them. That means that you've got more benefits. So now that the child is going out, most of their expense, instead of being rent, which is not deductible, they get a personal residence. Interest, property taxes, those kinds of things. Parents just have an investment property. So let's say 5 or 6 years later, they go to sell the property. Guess what? The child gets the Section 121 exemption, $250 per person, for exemption on your personal residence. Parents can do another 1031 exchange, either into a separate property altogether or to go into business of their kids again. That's a great use for 1031. And it's something as an idea that you can suggest to people who are trying to solve a problem. Because here you're solving a financial problem and you're also solving a family problem. You're helping people's lives work better for them. That's why we like doing these kinds of transactions, because it makes a big difference in where people are trying to do and get problem solved. And you can use the investment property rules to accomplish your objective. Now, as far as the mechanics are concerned, typically, as an exchange accommodator, all we need to get from the broker is the purchase contract, the preliminary title report, the contact information for the escrow officer, and client information, contact information, home address, contact information. Once we have that, we can prepare our documents, move them to escrow, and we work directly with escrow to get all of the documentation processed for the exchange. The money comes back to us, we park it and hold it at the bank, and from there, it's used to buy the next property. So it's a real clean process, and it's been made a lot simpler than it was when I first started back in 1980. It was a lot more confusing. You didn't, and the 45-day rule, we didn't have a 45-day rule. It was until 1984, but you had to be in contract on a property in order to identify it. In contract, as opposed to just listing the name on the deal. Now, this little piece of paper right here, if you keep this in your desk drawer, you'll find when you look through here, there'll just be examples of things that might just be helpful to you. Now, one of the things you can also consider doing, this involves a personal residence, and you know that a lot of people are selling personal residences. They've been in for a long time. They've got a cost basis of $100,000 and $1.5 million on the net sales price. And their husband and wife, they can take $500,000 exemption. But wow, they've got a big gain afterwards. One of the things we can do is have them move out of the property for 2 years, rent it, and if they sell it between the second and third year, we can make use of the Section 121 exemption and do a 1031 exchange for the rest of the property and keep it all tax-free. Now, you can also do a monetized installment sale, which is one of the things that John's going to talk about later, if you were going to sell it up front, where you could take your exemption and do a monetized installment sale for the rest. So these are strategies that you can consider as you're planning and working with your clients about solving their problems, and knowing that you can call either John or myself to answer your questions or to figure out, the details on your deal. And once you do these a few times, you'll start, it becomes fairly straightforward. And we'll make sure that, you get the information you need, but just feel free to call. That's how it works best. Okay.
Impact of, I have a 6-unit building, I'm living in one of the units.
Mm-hmm.
Impact on the 1031 exchange, the fact that my personal residence is part of this investment.
Sure. What you're going to do is you're going to work with your accountant as to how you've been reporting it on your tax return and what percentage you've been reporting. So then you'll take a look and say, what percentage is the personal residence? What percentage is the 1031? The 1031 exchange will handle that side. The other side will be handled as a personal residence, which you can then go into on a whole different property, or you can go in together again and pick up, partly personal residence, partly a deal. San Francisco has a lot of these unique situations because a lot of people use their investment property to purchase a triplex. We do a 1031 exchange into 2 of the units, and they move in to the top unit or wherever they're going to go. So 1031 can be used to achieve a personal residence objective, whether it's the 280A style or it's the one that we're talking about in your case. It's a useful tool to have, available to you. Yes, sir.
On the 280A, let's say the kids buy the house from the parents for $500,000.
But not buying the house from the parents. The idea of 280A is the parents and the child are buying a house from you or somebody else, but they're not buying the house from the parents. Now, if they do buy the house from the parents, let's say at a later date they get some money and they want to buy out the parents' interest in the house, they can do that, and the parent can turn around and do an exchange. The only difference is that the kids have to continue owning it for 2 years following the acquisition.
So you said as an investment property, the kids pay parents rent or income.
Right.
Over there. When the property is exchanged or sold, I thought you said they could take out $250,000.
The kids will own a piece of the property. So let's say the parents come in with a couple $100,000, and it makes up the down payment money. Okay, but the property costs $800,000. The kids go on the loan for $600,000. but they now own that percentage of the property. Parents own this percentage. So if the kids want to buy out the parents' interest, they can do that at a later date if that works for them. But the parents, if they don't want to pay tax, will have to 1031 exchange it into another property. And the kids will have to own that property they purchased from the parents for 2 years or more. And the parents, in trading into something else, will own that property for 2 years or more. There's some related party rules that you have to worry about under 1031.
Okay, before we do any more questions, why don't we switch speakers and then we'll have a whole question and
Well, Patrick, Ralph, everybody. So all three of these owners here have the same problem. Different product classes of property, but the same problem. And that is that the high capital gains tax we have here in California is preventing sales. A woman bought her house back in 1973, single mom, gonna raise her daughter. It's a big house, big property actually. It's on 2 acres, front house, cottage in the back, pool, about a ½ acre for raising horses in the back, even had a private drive around the back. But the house is a fixer. All around her, all her neighbors have these 2 to 4 acre Mediterranean manicured estates. And so at least once a week, an agent or a developer would call and ask if she wanted to sell her property, worth about $2.3 million. But when she talked about this with her accountant, and her accountant told her she'd have to write a check for $700,000 in taxes, she didn't want to consider that, from her perspective, living on a government employee pension. So it's sad. Four partners own this property. 2 of them want to put more money into it, re-tenant it, fix it up. The other 2 just want to sit tight. Don't want to put any money into it. But they could be bought out, but only at a price that would include the capital gains tax, which is way more than the other partners want to consider. So it's sad. A couple bought this property, George and Mary, bought this property back in the early 80s, actually traded into it. And George is getting tired of the toilets, the tenants, and the trash. Mary's getting tired of the rent control, the taxes, and the ever-expanding landlord requirements that the city keeps piling on. They'd love to get out of the business, diversify, have liquidity, so that they can spend more time with the kids and do some travel. But when they took an unsolicited offer for $4,130,000 to their accountant said, "Well, you're going to write a check for $1,250,000 in taxes." That was way more sweat equity than the couple was prepared to pay for, particularly after spending so much time working on the property. Now, all 3 of these situations, and many other situations that are identical to this, can be solved by using what's called the IRS calls a monetized installment sale. So that's a fancy term, monetized installment sale, but really it's not that complex. The essence is really just 2 loans, in which one loan pays off another loan. And what you get out of it are essentially 3 things. You get a high percentage of your net sales price in cash, which is non-taxable, that you can invest in whatever you choose. It could be into more real estate, stocks, bonds, pay down debt. It's a novel idea, paying down debt. You get a long time to sort out the tax bill, 30 years of tax deferral. And the administration of this is very simple with an automatic loan processing system. I sit on the board of directors for a company, Escrow Collateral Corp. It's really a dealer. They're installment sale accommodators, and they provide an installment sale accommodation, which is the first part of the monetized installment sale. And if you couple that with an independent third-party loan, you get those three things: cash, tax deferral, and simple administration. Now, to understand how this works, not why it works. It's not a tax course. And if you understand why it works, I suggest going to our website here. It is stuffed with tax doctrines and section codes, monologues, executive summaries. But if we understand how it works, probably the easiest thing to do is to go through a recent deal and diagram it. But out of curiosity, what's everybody working on here mostly? Residential, 1 to 4, typically 1 to 4. How about multifamily? Any office, retail, industrial? Okay, right. Well, what I suggest is to look back at the last situation we talked about with George and Mary's deal. So here are our couple. And what they did is they went out and they hired a real estate broker to get them the highest cash deal they could, the buyer. Now, if they just sold the property directly to the buyer for cash, they'd pay this tax. Because this tax, and so that's not going to work. So that's not going to work. So let's erase that and start over again. Instead of selling the property directly to the buyer and paying this tax, they sold it to an intermediate buyer, a dealer, an installment sale accommodator. In this case, it was our company. And then in turn, simultaneously, they resold it for cash to that final buyer. Well, now the final buyer's happy. They've got their property, it's free and clear of encumbrances, and so they can leave the table. So now we're left with is just a deal between the couple and the company. Now the couple sold the property to the dealer, the company, on an installment sale basis. Installment sales are, well, they've been in the tax code for years, all the way back to 1913 when the code was written. It's section 453 in the code. But the essence of an installment sale is just an IOU. It's a promise to pay, in which the buyer promises to pay to the seller their principal over time. And as the seller receives their principal, they pay their tax, pro rata. Now in this case, the seller sold their property to the dealer on an installment sale with a 30-year term with interest-only payments, no principal payments, and no collateral or no principal or no collateral. Now right there, the sellers have just received 30 years of tax deferral because it's interest-only payments, no principal. But if we just stopped right there, it's not a particularly good deal for the sellers, because all the sellers have now is just a piece of paper from the company and a promise to pay over 30 years at about 5.75% interest. So in order to provide a little more security to the sellers and to monetize the installment sale, our company has a credit relationship with a lender, an independent third-party lender who will lend 95% of the value of the installment sale note that the sellers have with the company on essentially the same terms and conditions as the installment sale note. And that would be a 30-year loan with interest-only payments, no principal payments, and no collateral. Well, now the sellers have cash, non-taxable loan proceeds that they can go out and make investments on. Now, there's one important term that the lender gave the sellers, and it's called limited recourse. Limited recourse means that the lender will only look to the company for repayment. They'll only look to the installment sale payments to repay the loan. So that means that, if the dealer, for example, or the company stops making their interest payments, the lender can only go to the company, not the sellers. So that means the sellers can't, all their other assets are not at risk with this loan. But you might want to ask, well, why would a lender do that? In real estate, we're used to lenders giving 30-year amortized loans that have at least one form of collateral. Well, the reason is that the company has cash. They have cash from that original resale to the final buyer. And if they invest that cash in accordance to the lender's investment criteria, the lender will give the sellers a limited recourse loan. But you see what's going on here, though? You have one loan is paying off another loan. And you get those three things. You get cash, tax deferral. Now, lenders like to get paid. So they typically set up an automatic loan processing system. And that really amounts to a long-term escrow. And every month, quietly behind the scenes, the escrow company reaches into the account of the dealer, of the company here. They take out a payment. They send it over to the seller's account. And then from the seller's account, they send it to the lender. It goes on digitally every month. At the end of the year, the sellers get an accounting of this, and they can report it on just two lines in their title, their two line items in their tax return, Schedule A, Schedule B. They have, there's interest paid and interest that they've paid, and the interest they've received. So it's the net tax effect is zero, no taxes, and the cost of this is about $300 a year. As long as the sellers, as long as the couple pays their $300 a year, this just keeps rolling on quietly for 30 years. Which brings up a good point, though. So, the sellers got more cash. Well, let's go back. I think, I don't know if the sellers really understood this flow chart, and you probably may not by tomorrow anyway. But what they did realize is that they had a couple of things. They had more cash than they would otherwise. They had a long time to sort out the tax bill, 30 years. And over that 30-year period, if they have a loss, they could offset it with the gain on the sale, so they wouldn't pay any tax. If tax rates change, like the current administration is considering, it may be in their interest. But even if they pay a tax in 30 years, it'll only be worth about 50 cents on the dollar with inflation. But that's a good question, though, is the sellers received more cash, but how much more cash? How much does the monetized installment sale cost to do this? Well, the costs are effectively the lender's costs. You got to blame it on somebody, right, Patrick? So the lender, they will loan 95% loan to value, so there's 5% there, plus 1.5 for their fees. So the effective cost is 6.5%. It's off the top, like your commission. Could be a lot. In the couple's case, their effective costs were about $265,000. but their tax liability was $1,250,000. So we're about $1 million to the good. So it made sense for them. So you got to compare when you're thinking about this strategy. Is how it works, with the particular situation for the seller. Now, for the sellers, the monetized installment sale was sort of a new idea. And it makes sense because the monetized installment sale was only codified in Congress back in 1980. And it takes a lot of work to develop a credit relationship with a lender who's willing to parcel off $300 or $500 million for installment sale loans. And I'm thinking that it was probably new in this situation also. Now, I'm guessing that there are a few folks in here that would rather be there than here. But and the story here is that a woman, an agent actually, who lived right around the point over here, she invested in a luxury home development in Southern California, and it failed. She ended up owing about $2.2 million to creditors on recourse loans, and all she had to pay for it was this house, worth about $4 million. Problem is, if she paid off the loans on the house and the capital gains taxes, she wouldn't have enough money to pay off her creditors. So she filed for bankruptcy and petitioned the court to use a monetized installment sale to help her out of her predicament. Now, on the other hand, the federal judge in the matter, a bankruptcy judge, who not particularly knowledgeable in tax law, reached out to the IRS, the Franchise Tax Board, to get their opinion, invited them to the hearing. They elected not to come. And so after the creditors approved the transaction, she sold her house, paid off the creditors, was dismissed from bankruptcy, and had $1 million left over to start again. So the monetized installment sale is not particularly complex. It's really just two loans. It's an installment sale loan that pays off a business loan. What you get out of it are those three things. You get cash, tax deferral, and simple administration. And just like the 1031 exchange, the monetized installment sale is a tool. It's a tool your sellers can use if they don't want to pay or can't afford to pay the high capital gains taxes we have here in California. So with that, why don't we open up for questions for both Ralph and Dow?
Let me add a couple of points. One of the things that we use the monetized installment sale for are cases of failed exchanges. You blow your 45-day rule, you can't make your 180-day rule. We're sitting here with a tax liability. We can convert the exchange to a monetized installment sale as a fallback position. So that's a good use for it. Another case comes in if you have a partnership and you've got a couple of guys that want to stay in and a couple of guys that want to go out, and then the guys that are staying in want to do an exchange as a partnership. We can monetize the installment sale out the two or one or whoever that wants to do a cash out without paying any tax. What you also want to remember is that going to the trouble of exercising the death option doesn't get you a step up in basis. It just because the sale under the installment sale rules took place during the lifetime of the decedent. So the heirs would inherit the note and continue the relationship, but the heirs would have the tax. And that means if you take your money and you invest it wisely, they should also inherit what you invested in with the money for the tax. So that's just a couple of points for you to remember from the tax point of view.
Right, so there are pros and cons with every situation. There are pros and cons with the 1031 exchange. It's complicated and a variety of other issues. Sometimes it doesn't pass. The monetized installment sale, it's a sale. And when you sell something, it's done. You're going to pay a tax at some point. We're not talking about tax avoidance here. We're talking about tax deferral.
Right.
Nobody's going to jail here, right, Rob? So there are some issues, some And so when you have a situation, I think the thing to carry away, to take away with this meeting is if you're running into problems with sellers' situation where they just don't want to pay that high capital gains tax, or that's an issue, they can't afford to pay it, then give Ralph or myself a call. We'll kind of see if it works. It may not, but it's a good chance. But as agents, and I've been doing this for a while now. I actually ran a commercial real estate office for a number of years myself. Our real job is to help our sellers, right? You help them solve their problems, and they'll help you solve your problems. Just getting paid. And one of the things that's very important to do as an agent is to get out and be with your clients. Well, a 1031 exchange or a monetized installment sale is an excellent way to have a coffee station or a lunch discussion with your folks. They may not do any of it, but you've gotten closer to them. The last time I checked, it's very difficult to make any money sitting behind your desk, right? So, question?
So I understand that if, let's say for the $3 million property you're selling, you have to pay the $1.3 million for tax gain. So could you show me an example as to like how that works with the monetized, like when do they get the payments? Because you're just saying you get interest and interest. What about the principal?
So in the monetized installment sale, really just again, 2 loans. And at the very end, the company, the dealer will pay off the loan. They don't owe anything.
But then as a seller, would you have the money to buy the next property, or you just get a loan from the lender? How would you?
I think I just ran the numbers on that,
Payments,
right?
95% is the payment. Okay.
Well, you get 93.5%. So
After-
if you
like,
sell the
that's-
property for $1 million, you get $935,000, and you can use that money as the seller for anything you want. And then you have a loan for $935,000 that you pay the lender, right? Because you still have to pay off
Right.
that
Well,
loan, right?
these 2 loans pay themselves off, so they have no consequence. I mean, one pays off the other.
I'm just saying, as of from the 3 million sales, how much would you get in, I guess, equity? for
Sure.
the next
What
property?
she was saying is correct. You're getting the loan proceeds back. So effectively, you got all your money out of your transaction. Now you invest that in something else. And if you're successful in investments, and assuming you didn't lose money all the way down, that money is available to be used to pay any tax liability 30 years from now.
And in the meantime, the dealer is paying off the loan.
Yeah,
So the seller's not paying anything.
it's a wash.
Essentially, how much, once I do this installment, how much cash do I have available?
93.5%.
93.5%.
And then you would take that and invest it, and then get the cash flow from that investment. Even more importantly, and it's another little point, if you buy another property, no 45-day rule, no 180-day rule. You can buy when the market goes down instead of buying under a sell high, buy high. You might be able to sell high and buy low. And and when you buy the new property, whatever you pay for it's your new cost basis. So you have depreciation deductions available going forward that you wouldn't have on an exchange. Because of the exchange, you're carrying over your old cost basis into the new property.
So one thing that comes up periodically is, what happens in 30 years? You got to pay your tax because everything collapses and you pay your tax. The simplest strategy to use is to take about 20 cents of every dollar of tax you think you'll owe in 30 years and put it into a TIA CRUF fund. Or a total market index fund at Vanguard or Fidelity, and just let it ride. If you do the future value calculation on that, you'll see in any 30-year period, you'll be way ahead of the game. And there's a good chance along the 30 years, something will happen. We'll have a 2008 tax or a stock problem. you can sell the stocks and you offset it with the gain on this sale. So that's the reason for tax deferral, is you don't know what's going to happen in the future. No idea. And if you pay the tax now, it's done. You're done. Right.
Question. There's no guarantee that the seller will get a loan from the lender. So what are the potential barriers? Is it just maybe?
No, if you think about it, the lender is really lending the money based on the dealer, not the seller.
It's a non-recourse loan.
It's a non-recourse loan.
The seller has nothing to do with it.
The seller's gone.
So you gave 3 examples. One was a private residence. Can she do a monetized installment sale, take the proceeds and turn it into an investment property?
Yes.
Any portion of it?
Yeah. Or buy a new house or buy a piece of each.
Yeah.
And remember, she
Or
could
do a
take a
280
$500,000
Yeah.
down payment
Right.
out
Right.
and then do an
If she's
installment sale
married.
with the rest,
Right.
and to use that with with a Section 121 exemption for personal residence.
Right.
Any lenders qualify for this, or everybody obviously, but is there any other?
Now, they have a lender relationship that's already been established.
So
Yeah, typically, because of the Dodd-Frank rules, the lenders are typically private equity. But it doesn't make any difference to sellers, it's just cash.
And you don't have to qualify
As
for
long
the
as it's
loan.
non-recourse,
Yeah.
How about, sorry,
using your example that you were talking about with the parents owning
the NEA?
the property and the kids living there and then
The
buying.
288 transaction.
Yeah, exactly. Sort of using that as a sort of an example, if they were charging the kids rent for the room that they were living in, and that they just decided they wanted to sell that property, could they? Is there like where you have a roommate in one?
Well,
of those, and you get 1031 on part of the?
Yeah, here's in the 288 transaction, the kids are occupying the entire property as their personal residence.
The sold property or the purchased property?
No, the purchase property
Yeah,
under the 288.
I'm not, so then set that aside. I'm just saying, like, I have clients who have a house that they want to sell, and they had roommates living in the downstairs or whatever, and they were earning income
And reporting it on their tax
and
return.
reporting it on
And
the tax
depreciating that part of the property.
return. Yes.
Like a home office thing, it's the same thing.
Okay, so then when they sell, they
It's
can,
just very similar to his situation in the 6 unit.
okay,
So we would take, the accountant would allocate
portion and portion.
between the parts. And then we could do the exchange for the part. Now, keep in mind that the value of the part that's a personal residence, let's say it's a single person, they've got a 250 exemption on that part, right? But let's say that the gain on that part is 300,000. Even though they did a 1031 exchange, they'd have to pay tax on 50,000 on the personal residence part, but all the part that's related to over here, it goes through the exchange. Thank you. Back here.
Yeah, so in the amortized, the dealer, how does that transaction go? Because you say the seller is selling to the dealer and then the dealer is selling to the buyer. So how does that work with us as being, so do we contact your company and put some kind of agreement in place, or how does
Sure.
that portion work?
It's a great deal for you guys. So you get your fee on your commission when you sell the property. And because our company is a buyer, we don't charge fees. I mean, the last time I checked, buyers aren't requiring to be paid a fee to buy a property, right? So, but the company does pay referral fees, 1.5 typically. So
So the 1.5 you were saying, the 5% plus the 1.5.
it doesn't come from the seller. It comes from retained earnings the company has made over the years. We don't charge a fee, and we charge a fee. The way the company makes their money, they have the use of the money for 30 years, so they can make money on that. And at the end of the 30 years, if we've done our job, then we ask for a 5% reduction in the principal we pay out. It's still the amount that pays off the loan, but it's 5. That's where that 5% comes.
So
So
essentially you're the buyer?
Yes, well, right. Just like an accommodator, we buy and then resell. Dealers.
But how do you establish market price? Like, I mean, typically we put a house in the market.
You're the one.
So we come to you and we say, okay, we want 1.8 for this house, and you guys decide whatever.
No, you gotta
No.
find a buyer.
They go to you first and they say,
You still have your job
we
to
want,
do.
yeah, you guys gotta do your work,
So
okay?
you get involved once
We
you
come
have
in
the
at the
buyer
end.
Yeah.
After the deal is set,
Yeah,
and you're all set to go, they
Then you
enter in,
grant, right,
just as we do as an exchange accommodator. I mean, the theory that on the way 1031 evolved back during the Starker days and for the early part of the 1980s, we acted as an intermediary, really a dealer in the same sense. Okay, and in the old days, we actually used to have to double deed the property in order to do an exchange. We don't have to do that now because the 1991 regs came out and said you could do it as a direct deeding exercise. And I think you're doing a direct deeding exercise as well.
Could this model be used for estate tax deferral or?
Estate tax?
Yes.
Well, sure. I mean, one of the things about the installment sale, the notes are discounted for estate tax purposes. Now, that may all go away, next year, but yeah. So it can be used for estate tax reasons.
It's not going to. It's an income tax transaction, though. That's what it's about.
Right.
I mean, if there's a discount applied to the note, that might apply to staying under the 5 and some odd million, deal. They're already talking about eliminating the estate tax as part of this proposal going on in Washington. For the record, I was back there about 4 weeks ago, working with the Federation of Exchange Accommodators and walking the halls of Congress to fight for the proposal that's been advanced to eliminate 1031 from the tax code. That's actually on the table. My impression, by the way, going back there, is that I had just arrived at a zoo where all the animals were out of their cages and they were eating one another, and all the zookeepers had retired. That's Washington, D.C. today. It's a civil war going on in Washington, D.C. So it's really hard for any of us to predict which way that tax thing or the healthcare thing or anything else is going, because all the animals are eating one another. So we just don't know where this thing's going to go. We hope that we can eliminate it. NAR and a lot of the real estate organizations and the Federation of Exchange Accommodators are all fighting to keep that provision, out of the change. The one-page thing that the Trump administration put out about a week or so ago doesn't even talk about it. But the devil is always in the details. And the details are all in the congressional committees and in Congress and all the rest of it before it finds its way out to the president's desk. So we don't know where that's going to go.
They just sidelined it for a year, though, didn't they?
No, they haven't sidelined it. They're going to be talking about it. And the first thing you want to remember about Washington, don't trust it. Whatever they tell you is not going to be the whole truth. And the problem is you have a civil war going on in Washington between the Republican elites, the Democrat elites, the bureaucracy, all the civil service type people, and then the Trump people, which are partly Democrat, partly Republican, and the press. So you got 5 combat people all going after one another in Washington, D.C., each one trying to do the other one in, and none of them solving the problems that we would like to see solved as people. We're the ones that are being left at the table by all the political parties. And that was really evident when I was back there.
So Ralph, I think this is homework everybody can do. You can write your assembly person and
Not
if you
assembly
go,
person.
Senator,
Senator Feinstein.
the 2 chambers, you can go to his website and they can download the links to write letters, which is very important. I mean, it's a tool for your sellers.
The question, one for each of you. Starting on the exchange, assuming if I'm selling and I want to trade, assuming liquidity in my property is going to sell, right? To buy more time off that 45 days to identify, I could just preempt that, go into a reverse exchange and get another 45 days?
No, what happens with a reverse exchange is you haven't sold yet.
Exactly, I'm saying. So
you will actually buy 180 days to sell.
Right.
Then you still have another 45 days
Great.
if you want to buy a second property to go along
So-
with the one that we're holding for you.
Right, so assuming the liquidity when I go to sell, I can then buy an extra whatever is 225 days by entering reverse exchange.
Yeah,
first.
effectively. I mean,
Okay.
it's yeah. The other nice thing about it is, let's say that we park a property for you. Let's say that we bought one for you and you've just sold yours. Now you're ready to go, except that you want to put in $200,000 worth of improvements in order to get the sales price up. We do a reverse improvement exchange on that,
Right.
borrowing funds from our exchange intermediary to fund that. We'll get that up so that you can trade up instead of paying tax on $200,000
Right.
trade down.
But I can buy time by going with reverse exchange.
Absolutely,
first.
it's the whole purpose of the reverse
Right.
exchange is by time.
And then secondly, on the installment sale, so I'm trying to convince a guy to sell me a building right now, and it's very similar. I've owned it for 50-something years. Basis is nothing. So if I go to him on the installment sale, so just walk me through it really quick. Is we agree on the price, I pay you the money. Excuse me, I pay him the money. Walk me through how it benefits him.
Okay, so, well, you've got a deal and there's nobody else involved.
Correct.
So what you would do is, before it closes, we'd organize the deal so that first the sellers would sell our company the property.
Right.
And we would sell it to you.
Right. At the price that we negotiated.
Yes.
Exactly. Okay. Done. Got it. And then we have the lending relationship between you and me and the lender.
And then you as the buyer,
But if for the deferment, even if I pay him all cash,
yes,
or pay you all cash,
You're going to pay escrow all cash.
pay escrow all cash, right? But the installment is really just the loan. And we could work that out. It doesn't have to be 30 or fully amortized. We can do a 5-year, whatever the deal that you and I would then make between each other.
actually you're done. If you're going to pay him cash originally, what you do is you pay our company the cash.
Excuse me, I'm out of it. It's what he then
You're
negotiates
gone.
with you that's better for tax efficient for him.
Correct.
Right. What
Yeah.
he does is he gets basically those three things. He
Right.
gets
Got it.
cash, gets his tax deferral, and then the administration, which is not
Which
on
is
him.
exactly got it.
And you're done.
I'm done,
You're
right.
happy. You're
Yep.
out of the picture.
So when you do I have two questions. The reverse exchange, you buy a property first, and then you're going to sell. When you buy that property, do you get the keys to it and you can move into it?
No, well, you're not
to
going to move into it anyway because it's not investment property.
Right.
You're moving into it.
Right, that's true.
But when
you can rent it.
Yeah, well, what we do is we buy the property. We have a qualified exchange accommodation agreement that spells out the relationship, and we give you a master lease.
Okay.
And then you control the property, collect the rents, do all the things you do as if you had just bought the property.
Okay.
So you have complete control over the property.
Okay.
So if you initiate a 1031 exchange and you're, let's say, running out of time, you're at day 44, you then go into a monetized installment sale.
Yeah, we can convert it if it looks like you're going to fail the exchange.
So you don't have to initiate the monetized installment before the.
No, we just get in touch with John
so
and his.
it's instantaneous. Let's say the same. You can start it the same day.
Well, there's paperwork to be done.
Right.
Not instantaneous. I mean,
That's probably good.
Have there been IRS challenges to the installment sale?
Well, I think what you're asking is, there been a private letter ruling or this or that, right?
or a case,
Or a case?
or an audit.
The monetized installment sale, the chief counsel came out in 2012 with a very complicated, convoluted monetized installment sale on a very, very big deal. It involved 4 banks, not one, and it was, you'd have to, it had all these different little machinations. And the IRS said that was all right. What we do today is very simple. We haven't had any private letter rulings because no one, and the seller would have to initiate that because it's expensive. Just to get in the door to get a private letter ruling and expedite it. I think the IRS charges $16,800 just to get and put it at the top of their desk. And so we haven't had any private letter rulings. There have been some bigger deals. Office Depot, where they sold to Boise Cascade on a $1.65 billion monetized installment sale basis. You can read it there because they're a private or a publicly held company. You can read all about that from them. So there have been much bigger deals. But on the local side, there's been no private letter rulings.
Yes, ma'am.
Are there, I have two questions about the monetized installment sale. Are there any requirements or restrictions on the funds that the seller receives from the lender?
Yes, that's a good point. So the lender is a private equity lender and the loan is a business loan. So in order to deduct the interest payments on the loan, at least initially it has to go into some kind of investment. It has to be something. It could be a money market fund. Money market funds are investments. So now what's important, because I know that a lot of you folks do residential, from 1 to 4, and so the question comes up periodically. Well, can I just sell my house? If that's my major asset, can I then just take all that cash and buy another house? It's a little tricky. There are a couple of other steps, because if you take that cash, which is designated for investments essentially, because you want to be able to deduct the interest payments from the lender, then if you just buy a house, which is technically personal property, if you just did it across the board, you may not be able to deduct the interest payments from the lender. But there are a number of ways to solve the problem. I mean, a couple of weeks ago, a woman sold a house down in the South Bay here for $3 million, and she took all the proceeds of the sale and put them into an investment account with Vanguard funds. Then she took a distribution. It also depends on how your accountant wants to treat it. You got to talk to them too. We always recommend that in any of these deals, including a 1031 exchange, you bring on board your accountant or tax attorney to review any structure, because they're all different. Each one's different. Everybody has their own circumstances. So it's a very important piece of the whole thing.
I have a second question. So I do reverse mortgages. All my clients are 62 or over. So in 30 years, they're most likely going to have chosen that death option. And what if they don't have heirs and they don't have any money left? What happens? Because a lot of my clients don't have heirs.
That's a good question.
You're volunteering to be an heir? Is that what you're
That's an idea.
So does your company continue to pay the state?
No, you could actually leave it to a charity.
Yeah, leave it charity. And then you get a full deduction. I mean, I don't think you have to do anything. If you die and you don't have any heirs, what are they going to collect? So
It's going to go into their estate plan, whatever that estate plan is.
For the reverse exchange, so from my experience, I thought that you have to have the funds to be able to purchase, because you guys the property that you're parking. So are you guys actually lending the money to the?
No, what we do, here's what happens. Remember, equity,
right,
debt, net sales price, right? So let's say that you've got $500,000 coming out as equity, and you're going to buy, and you have a net sales price objective of $1 million, and you're buying a new property for $1.1 million. Okay, we get a new first mortgage that you will assume when you take it from us for $600,000. Now, the $500,000 that's going to come from the exchange has to be made up. It could be a combination of a bridge loan second from the same lender as did the first, assuming that it's within their loan-to-value relationship. So if they're loaning here, so say 50%, and they can go to 70%, they'll give a $200,000 loan, in here as a second. Then you have to come up with a third from your own funds, or from you do some kind of an equity line in your house or some other set of circumstances. In some cases, we've actually been able to get 100% financing from a lender on a bridge plus a first. But a lot of that really depends on the client's credit and the client's situation, because a client could provide additional collateral. From the bank's point of view, they want to be sure that they've got sufficient collateral to cover their loan requirements. But it all gets set up. And then when you buy the property from us, the second and third are all paid off out of the exchange proceeds, and the first is assumed by the buyer.
Real quick before there's any more questions, I'd like to take a quick survey. Survey is everyone going to remember everything that was said today? Okay, just.
Well, I will.
So Ralph and John will. So our wonderful videographer, Jose Duval, is recording today, and I will have access to that recording, and I'll happily share it with you if you email me. Okay, so if you want to have access to this, because it's great information, you want to pass it on to the client, use it in the future.
Yeah.
Can you go through the section 280A? I've never heard that before, and I think I heard part of it, but I don't really completely.
Well, see,
understand.
what the distinctive difference between a 280A and a standard TIC
Yeah.
is that you don't have to be pro rata on the debt and the equity and the income expense things. In a standard TIC, I put in $1, you own $1, we each own half.
Right.
Okay. This case, the child can put in some money
or
no money and take it all on as debt and get the personal residence deduction on the interest. Whereas the parents just treat it, they can take some of the loan if they want to as an investment loan, or they can do just theirs with all equity. Sometimes, like the parents might find one trade property and have some cash left over, then rather than paying tax, they put it in as a down payment. You know, the extra cash they have left over from the exchange, and put that in to create the down payment necessary to convince the lender to make the loan to the children. But it's the key to it is an equity sharing agreement. And the equity sharing agreement is like a tenants in common agreement. It is a tenants in common agreement, but it spells out the relationship consistent with the words in 280A.
Okay.
And that's all done by an attorney.
Yeah.
And we have an attorney that we use that we refer people to. And then that gets recorded, or a memorandum of that gets recorded at the time of the closing. So now you have proof that you're doing a 280A transaction. And the only requirement that comes out of it is that parents should receive fair market rent. So let's say that the property, the parents are buying a third of the property, and they figure out that they've got that $9,000 a month is fair market rent, then they would only be entitled to $3,000 of rent.
Right.
But they can probably do it at 90% of $3,000 because it's a reliable tenant. So they still have to do a rent piece, and then the parents recognize that on their tax return.
Are foreigners qualified for this, or this is just good?
Foreigners can do a 1031 exchange if they're filing here in the U.S.
I'm saying the 280A.
Yeah, I mean anybody who is a legitimate taxpayer in the U.S. Could do it, and they could do if they didn't want to do an exchange, they could do it. They could set up an investment thing, just buying something, as a 280A transaction. And if they wanted to keep it so that they could trade it later, then they would set it up as a 280A. But they wouldn't need us to do that particular part of the situation. We only come in as if they're doing an exchange and they want to exchange into something that will become a 280A. But the 280A is really a wonderful tool to allow in today's marketplace, where it's crazy. I mean, I don't know how people buy their own homes today.
Is it, let's say, I use my house as a single family residence, and on my taxes I claim it as 50% as a home office. Can I take that 50% and if I sell the house and use it as a 1031 exchange?
Yeah, as long as you're reporting that and depreciating it and doing all the rest. Because if you sell it as a personal residence and you fail to set up as an exchange, you will pay tax on that part because the exemption for 121 doesn't count against the depreciation.
And how long do I have to claim it as, let's say, a person as an office? How many years? Is it 2 years? Or I could put it as...
When you say claim it as, you can claim it as whenever you want to, but generally speaking, whenever you make changes in structure, relationships like moving from partnership to tenant in common, or changing anything that looks on its surface to be taxable, and then you paperwork it over to make it look like it's not taxable, that's called a step transaction. And what the IRS can do is they can come in and eliminate all the steps and go back and tax you. So what's a safe harbor is the question. And typically it's 2 years. So, for example, a second home, is not a 1031 property. So rent it for 2 years. Let's say that you want to trade into your retirement home. Okay, trade into the retirement home, rent it for 2 years, convert it to a personal residence. So, and a second home, by the way, if you haven't got another exit strategy for it, right over here, monetized installment sale for a second home. So each of the things that John and I are doing offer alternatives to you and your clients to achieve tax beneficial objectives. That's the whole idea of the deal. I mean, it's amazing what's out there, and it's amazing how many people just have no clue as to what it is. And that's why we try to always be available to you or your clients. We're always happy to meet with your clients. They want to come down to the office, come on with them, or send them down. We meet with them, we talk with what they want to do, and we help them to understand what they're going through. It makes your job a lot easier. You can focus on what you're trying to accomplish for them, and your clients feel like, wow, this is really cool. I didn't know I could do this. And now you get the benefit from having, sent them down.
Just a quick question regarding monetized installment sales and second properties. Say a client owns primary residence, they purchased into a property as an investment, for appreciation, but now they want to sell the second property and may run into the issues highlighted earlier with regard to real property technically being personal property. If they wanted to buy into something new using the proceeds from a monetized installment sale, would the investment category of the asset preclude a second property that they were interested in purchasing for an investment? Or would that sort of bypass the need to put it into a brokerage account or an investment account?
The second property, would that be just for personal use?
Well, it would be might be for personal or just appreciating value as far as real estate being a solid investment.
So the key to all of this, including the exchange, is intention. What's the original intention when you start out? Are you intending to keep it? Or a developer, for example, condominium developer? They're dealers. They can't use an installment sale because their intention is to buy it, fix it up, and sell it. But if the intention is to buy it, hold it for appreciation or rent or whatever it is, investment, then that's fine. But intention is really the key.
Yeah, the intent in this scenario would be, it's a second home, I want to keep it for the foreseeable future, potentially move there in 5-10 years, but hold on to it and see it appreciate in value as an asset.
If you're holding it for investment, you're renting it. So when you use it as a second home, it's still a personal use property, is what he's saying.
Okay.
So think of it from the same thing, is it investment or personal use? And when you're into investment, you're clean. So it could be stocks, could be bonds, could be the money market fund, or what are you talking
Pay
about?
down debt, other things.
There's a variety of ways you can solve the investment side.
A lot of second homes are also investment.
Well, if they're used as vacation rentals and you're using it 14 days a year or something along those lines, you can do that.
There are a number of ways to solve that problem. It just depends on the circumstance. Everybody's different. So.
If we have clients to refer over to you, are you guys able to talk to them for a quick 5 minutes?
Oh yeah, sure.
Okay.
Do it all the time.
Yeah, what's a fee if they come
No
to
fee.
your office?
No fee.
We just do it as a service to you guys.
Oh, right, okay.
Yeah, we've been doing that for 37 years. I mean, you can't, if you're working in any of the major firms, we've worked with most of the major firms in the city, with somebody in your office, at some point in time. But all of our business really comes from brokers.
We're free. Time certified, time stamp.
We're free.
Awesome. Great. Well, it's like us, you only get paid if you buy the final thing, which is.
Well, that's why we get a lot of
keep it,
referrals.
right?
All of our business is referrals. That's really good. Anybody need a card? Here's a card.
Thank you very much.
Thank you very much for your time.
Hi, Carol.
Good to see you too.
Never heard of a monetized installment.